Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So again, if this systemic risk starts to raise its ugly head again, or if there's some trade concerns that start to flare up between the U.S. and China, and now Europe is finally starting to voice in a big way their concern what China's doing on the trade side of the fence. This is the pair we want to be on. We think this will crack very, very fast. The commodity currencies in here. But if we muddle through in here, the U.S. maintains a modicum of demand and keeps the spigot open, monetary spigot open, and says they want to do some more, and even hints at quantitative easing by the Fed. And as I said, a modicum of demand that can continue to take Chinese exports, and tolerate a continuing trade deficit with China, then this relationship. This trend will probably continue, and the commodity currencies will continue to move in a very, very big way against the U.S. dollar. We think we're getting close to a real judgment point here in the next couple of months. So I have to see how this plays out, obviously. But this is the one we want to ride: the commodity currencies on risk. I throw this in here. This is just a chart from The Economist magazine, and this is the Big Mac index, which gives a kind of a down and dirty evaluation of over and undervaluation against the U.S. dollar based on how much it costs to buy a Big Mac in a particular country. Just looking at the one at the top to show you how this works. This is Norway. Here's the zero line. This says that Norway right now is about 81% overvalued against the U.S. dollar on a fundamental basis based on the Big Mac index. And you can see that the euro area itself in here, 25%, more than 25% overvaluation, even though the euro has tanked so far, what people seemingly think is so far against the U.S. dollar. So another reason we think there's further to go. Now, if you look down the bottom of this, you'll notice all these countries, Asian bloc countries. They don't have Singapore in here, but Singapore would be in here also. This is relative undervaluation against the U.S. dollar. This goes to the point of the Asian bloc currencies have been suppressing their currencies for a long time in order to support their export model. We think that will change. This whole idea of global balancing will change on a long-term basis. We want to be positioned in these currencies. Again, it's sometimes hard to buy these and find out how to buy these. The Singapore dollar is one that's traded on spot Forex. It's hard to get access to some of the others. Obviously, China doesn't really move until they want it to move. But the Asian bloc currencies, you can see, extremely undervalued. And what are they most undervalued against? They're most undervalued against the European currencies. So, example, Thailand right now showing about 30% undervaluation. In Norway, 80% overvaluation. That's 110% fair value valuation between those two currencies. So our long-term play, and we just wanted to point this out, no matter what happens in the world, and we think these valuations won't be squeezed out if China gets in trouble, but these valuations may widen. So if China gets in trouble, we would even want to add to the long-term play in these currencies. But just wanted to show you there's some other plays that you can do outside of just the dollar, thinking in dollar terms itself. And I think following the Big Mac index is a good way to see these. And that's it, Steve. Go ahead and take questions. I'll let you finish up.
Yeah, Jack, awesome presentation, as always. I have a couple questions. People were typing as you were delivering your material. First of all, Jack, would you mind commenting on your recent change of your subscription, and how can people find out more about that?
Sure.
If your service is for them.
Sure. We just decided we had offered a free newsletter, Currency Currents, and I've written it every morning for about 6.5 years. John Ross of late has come on board and helped out that process. We're just watching what's going on in the market, and we really got tired of playing in that newsletter, crowd. trying to compete with, these newsletters that give these, overvalued promotions and do this, do that. We just said we want to find people like ourselves, and we were going to stop and content protect our stuff and only let our customers look at it and just not give away much free research. These are the only things that we will give away for free is some of these webinars, information that our clients see first. But we just made that change, and we've beefed up the newsletter in a very big way. We put a lot of effort into it. We spent a lot of money on research tools to do that, and other research outlets that goes into it. So we raised the prices, and we just hope people find value in it. We think the value is there over the long run, but it's for the type of person that can appreciate real life stuff, not hype, and we just changed the business model. And part of that change too was we can't do much promotion anymore. We won't be doing because we started managing money, and we're managing money as registered CTAs. So it kind of all went together and changing the business structure. And if you go to our website at blackswantrading.com, you can learn all about the newsletter. I have all the details of what you get in there. It's not just the letter. There are a lot of other things, and weekly analysis, webinars that are all included, just member webinars only, and things, meetings and things like that. So it's a lot more than just a newsletter. So please, if you have any interest, go to the website. You can find the details.
Wow, Jack, that sounds really exciting. So good luck. And I'm sure there'll be many people that are going to be interested in that kind of service. As you said, obviously, when you provide content, you need to get paid for it, and we just wish you the best. A couple other questions. Expecting U.S. dollar growth, what can we expect from bonds, notes, and indexes in gold? I guess, Jack, you are expecting more growth in the U.S. relative to Europe. So what do you think about bonds and U.S. stocks and gold?
Well, we think we're in a nasty deflationary pattern right now. So we think bonds in general will continue to do well, price-wise, and continue to hold up. If anybody's watching these CPI numbers and just the number, all around the world, not just the U.S., they're coming in under expectations. PPI falling outright in some cases. This goes to a lot of the factors, just under capacity growth, we think, throughout the industrialized world economies because of all this overhang of debt. We don't see it as inflationary. Because of this under capacity growth, we don't see the pricing power coming into the system because the system's not getting the money, getting the juice that's sitting there in reserves. Ultimately, this wall of money, if we get a vibrant recovery, but we think it could be several years down the road, may cause a real inflationary problem. But until then, we think deflation is in play. When we say the U.S. is going to grow faster than Europe, it's a very, very relative game here. The U.S. is going to be very below capacity historically, but we think that with austerity settling over all the Eurozone countries, their growth will plunge dramatically. And because of that, the U.S. even just tiptoeing along is going to look like a growth tiger compared to Europe. So that's what we see the relative growth differential there. And in both cases, we see at least we see German bonds going higher. The rest of the bonds over there are an absolute crapshoot. It could collapse at any day if the wrong thing is said. I mean, if one of the policymakers powerful, wakes up one morning in Germany and says, this whole European experiment is a total mess and it's screwing up our financial system. It's time for us to leave. You'll see those yield spreads between Germany and Portugal, Spain, Italy, all those things all of a sudden just surge to where they should be, where the market would value them. And we're probably looking at the 10% area at least. So the bonds, you have to, but we think German bonds, U.S. bonds, Japanese bonds, despite their, continued massive, debt to equity, debt to GDP ratios, will be fine because of deflation in general.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.